Good day, friends. We have started a new lecture series on personal financial planning. In the previous lecture on the personal financial planning, I talked about what is financial goal, because financial planning starts with determining the goal. Goal can be your own education, your child's education, your marriage, your children's marriage, your retirement planning, you're buying a car, buying a house, and so on and so forth, right? So when we talk of the financial goals, these are normally the goals which you cannot meet out from your monthly income. That is, whatever you earn in a month, from that income itself, from a monthly income, it is difficult to achieve that goal, right? For that, you have to plan in advance and you have to save that much and invest that much, so that whenever you have that much expenditure or that much money which you want have to invest on that thing, you must be having enough money so that you can make a timely expenditure on that, right? So for that, we have to prioritize our goals. We have to make the different goals, but you have to list your different goals, prioritize them. As I've just talked about the different goals, you have to prioritize them, right? And the goals must be determined in the manner of the short-term goals, medium-term goals, long-term goals. The goals should be the SMART goals, which should be measurable, which should be quantifiable, which is specific, which should be time-bound, that within this time you want to achieve, right? And means that you set different and specific goals. For achieving those financial goals, there must be a proper planning, right? And this, the way you do in the business, similarly in your own personal life, you must have a personal proper financial plan so that you can meet out your desired financial goals. So the process of financial planning includes two steps. Number one, to specify your goals. Exactly, you must determine SMART goals, which I referred in my previous lecture on the personal financial planning. And secondly, to describe your spending, financing and investing plans to achieve these goals, right? How much you will spend each month out of your annual or your monthly income. Whatever the financial goals you have, how you will finance them. When you say finance, the way we say in a business that financing of the business is by your own sources or through debt. I mean, when you start a plant, you spend 100 crore rupees on machine and different assets, buying a different assets. How you finance then? How much your own money, how much your borrowed money, and how you will plan it. Similarly, for meeting your specific financial goals, you must determine in advance, you must plan that how you will finance, where from this money will come. Simply put it, where from this money will come, that is called financing the financial goals. And investing plans to achieve these goals. See, I want to buy a house after 10 years, which will cost me 1 crore rupees. So each month I am making some saving so that I must have, after 10 years, I must have that much money of 1 crore rupees to buy a house, which is my long-term goal, right? So this savings of mine, which I am saving every month, I must invest smartly, so that from the saving I can generate income, and the savings plus the income accrued on that savings, that will help me in achieving my goals. So when you talk of the financial planning doesn't mean only your budgeting and savings, and it also involves smart investing. That idea is so that whatever you're saving, you must invest your savings in a manner which can give you good returns, which can give you good yield. Yield means every month or every year, whatever you are earning out of that you must invest in a manner so that it is safe, it is liquid, and it can give you good returns. So investing is an integral part of the financial planning. Financial planning helps you to ensure that you will have funds available to meet your present as well as future needs. So at the time of the requirement, I said I want, like a person like me whose children are in the marriageable age group. So after 5 years, I want to marry my son. On marriage, on this social occasion, I want to spend X sum of money. So after 5 years down the line, when I'm planning to marry my son or my daughter, right? At that point of time, I must be having that X sum of money, right? So I don't have to borrow from somebody. I don't have to take money from my friends and relatives to meet out my even social expenditure, right? The expenditure on which I'm making expenditure on social occasions. So I must have that much fun so that it is called good smart planning, right? Focuses on the management of financial resources. Whatever the financial resources you have, resources, when I use the word resources, I'll be talking in length about the assets and liabilities and all those things. Whatever your income, current income, plus your accumulated funds which you have, all the resources which you have, you must manage them properly. When I use the word manage them, you must invest in a manner so that it can give you good returns. Personal finance is an activity that involves all individual financial decisions, which includes budgeting, savings, insurance, and mortgages. When I use the word budgeting, as you know, and other subjects also you have studied budgets, right? In cost accounting and other, we do study about the budgets. What is budget? If I talk of personal financial in context of the personal finance, I'll say budgeting is what is budgeting? If budget is a quantifiable statement which is prepared prior to a period of time for the objectives to be achieved during that period of time. If we are a good financial planner, we must make our monthly budget. It may be in the black and white. It may be in your mind itself. I'm earning 1 lakh rupees per month, right? What are your monthly expenditure? My receipts are 1 lakh rupees per month, and my other source of income is say 20,000 rupees per month, right? This is my receipt side. What is my expenditure side? How much I spend on kitchen, how much I spend on electricity, how much I spend on water charges, the petrol charges, means your conveyance, your transportation, your clothing, and so on. So your child's education. So this is on the expenditure side. So you prepare a monthly budget, right? So monthly budget is a part of the financial planning. Savings. Out of the budget which you prepared, you say 1 lakh rupees income, 70,000 rupees is your monthly expenditure, 30,000 rupees each month you will save. Insurance. See, any exigency can arise, anything can happen in life. It may be, any unforeseen circumstances can arise. For that, you must make insurance. Insurance may be the health insurance, it may be the general insurance of your house, against fire, against theft, so many things, right? Insurance may be of your car, your movable property, right? And the mortgage. Mortgage means, suppose you are having your own house, or suppose you want to take a loan. And for the purpose of taking loan, you want to mortgage some of your asset. That is basically mortgage part. So, but that mortgage must be done in a very efficient and manner. Say, having a loan for a house, I will not say it's not a good thing, it's not a bad thing. But if you're taking loan to meet out your day-to-day expenditure or monthly expenditure, I would say it's not a smart financial planning. You must see to it that you are able to meet out your monthly expenditure from your own source of income, right? So, financial planning involves budgeting, saving, insurance, mortgages. Personal financial planning refers to the proper planning and implementation of well-coordinated plans to achieve financial objectives, right? So, whatever your financial goals are, whatever your financial objectives, you must be able to achieve it properly without any, too much botheration, without any sleepless nights, right? Suppose in an illness takes place, an accident takes place, and suddenly you have to spend 5 lakh rupees on the medical expenses. How will you meet out these medical expenses? If you have done proper insurance, if you have taken a health insurance, right, from that health insurance you can meet out. Had you planned earlier and used to pay regular health insurance premium, you will not suffer on account of this. At least financially you will able to meet out your financial goal of expenditure on medical expenditure, right? So it is a smart financial planning. So saving and investment made today should match future goals. we must make that much saving so that we can able to achieve our goals. Taking conscious and systematic steps toward fulfilling one's financial goals. The process of meeting life's goals through proper management of finance means, we're saying, what is financial planning? It is a process of meeting life's goal. What are the life goals? I have talked about earlier, like child's education, buying a car, buying a house, going on vacation. There can be any number of, I'm talking of a few goals that can be depending on individual, because each individual has his or her own financial goals. It is difficult for me to quantify that these are the financial goals, right? Depending on your own requirement, depending on your own priority, depending on your level of income, depending on your age. If a person of 60, 70, say for example 65 years, 70 years, his financial goal will be different. A person of 20 years will have different financial goals. A person of 70 years will think of more of his health expenditure, will think of more of his meeting out his monthly expenditure, right? Because monthly expenditure means, because he is not a earning member or she is not a earning member at that point of time, that person is retired, and supposing the person is not in the pension, is not pensionable job, so right, so where from he will able to meet out? He must make, had he done good financial planning at the time when he was in the earning age group, at that time itself he must have, if he had planned properly, that after the age of 65 or 60 years when I will be retiring, if you have made your retirement goals very clear, retirement plans very clear, you will able to meet out your expenditure, keeping in mind the inflation, keeping in mind your requirement, your medical expenses, whatever your financial goals are. So what I'm trying to say is that financial goals will depend on individual to individual, depending on your age group, depending on your income level, depending on your lifestyle, depending on your priorities of life, right? Your financial goals will be different. Personal financial involves much more than managing and investing money. It is not only managing and investing money, it's a broader term, right? So it includes making all the pieces of your financial life fit together. It means lifting yourself out of financial illiteracy, that you are not unaware of the financial aspects. You are aware which are your investment options, which are which are 100% safe. Say you can invest in the bank FD, you can invest in the post office, you can invest in the PPF account, you can have in the public provident fund account, means PF account, right? PF account and PPF account are two different things. You can invest in those things. Means these are safe investment. These are investment in the government bonds, treasury bills. So depending on your priorities, if you're illiterate, you may not be aware of these are the different instruments which are available for investment. But if you're a literate person, if you're not a financially illiterate person, then you know these investments, you know what are the returns, what are the tax implication. I'll be talking of all these in the other lectures, right? The different instruments which are available, right? So depending on your goals, depending on your profile, the investment opportunities will be different. So means you must make out yourself that you are not financially illiterate. Like planning a vacation, managing your personal finance means forming a plan for making the best use of your limited time and money. So after talking of what we mean by financial planning, now let's talk of what is the need of financial planning. Very importantly, I will say seeing the future with a clear vision. The need is that you want to see that a clear-cut vision you have, clear-cut things in your mind, clear-cut plans, blueprint you have in your mind, that what you want to achieve. When we have a goal to be achieved, we will be clear about the future. And through financial planning, we should be able to follow the steps needed to achieve these goals. Without a financial planning, it would be like groping in the dark and every day's crisis management. Means suddenly, as I was saying, just talking about that an accident takes place. And on the for that, medical expenses of 5 lakh rupees, doctors have said estimated expenditure of this operation will be 5 lakh rupees. Right? So 5 lakh rupees, where from this suddenly this expenditure has come to you. Had you made a smart financial planning, you will not be in trouble. Have you taken the 5 health insurance of this much sum of money, right? You will not be difficult for you to at least spend the money on your medical expenses, right? So every day's crisis management will not be required. You have smart financial planning in hand. Ensuring financial discipline. What we mean by financial discipline? Each one of us must spend judiciously. When I use the word judiciously, I'm not saying don't spend your money. Spend it, but spend it judiciously within your income group. Like when you make financial planning, when we generalize it, we say we must save 30 to 40% of our income. It's a general rule, depending on your level of income. But if I generalize it, you will say a person is earning 15,000 rupees, how will he able to save 30%, 40%? Agreed, right? But I'm generalizing that if you're in the middle income, the higher middle group person, you should save 30% of it. Even if you are earning 20,000 rupees per month, I would say at least save 10% of it, so that any expenditure of some amount comes, at least you are able to meet out, right? So this is called financial discipline. Whatever my limited income may be, I must save a small sum of money. As my income level goes up, the proportion of saving should also increase, right? When my income is 20,000 rupees per month, I am saving hardly 10%. If my income is increased to 50,000 rupees, I'll not save 10%. I must save at least 20%. Friends, I'm not giving you an exact formula, but I'm just broadly generalizing these things, that as the level of income increases, so should be the proportion of your savings. So proper planning helps one to limit her expenses within the budget. It can ensure that planning is done for the various events in one's life and the money required for meeting them. Giving the person a direction means what financial planning helps. It helps a person to give direction to. Planning sets forth the future vision of the individual. It helps to attain the various goals in life. Improving a person's financial decision making. See, if you have a proper plan, it will help you in taking good financial decision. If financial planning helps a person in making the right decision about the spending, right, how much should I spend, and also investment and availing loans at the appropriate time, right? As a loan, see, taking loan for the productive purposes is not bad, but taking the loan for wasteful expenditure, and what is wasteful, it's again a very subjective term. I want to go for a vacation, and for going on a vacation I am taking a loan. Friends, personally speaking, it's not a very good advisable thing, right? You must, these are your expenditure. This I would say a luxury. This is not a necessity. You must categorize which are your necessary expenditure and which are your luxury expenditure. Again, what is luxury, what is necessary, depending on the income level. But I'm talking from a common man, a general middle income group person, right? You must prioritize what is your essential expenditure, what is your necessity, and what is your luxury. See, there was a time in India, some 30 years back, refrigerator was a luxury. Today it has become a necessity. Television was a luxury some 25 years back, 30 years back in India, but today it is almost a necessity, right? So for even a lower income group person, you will find a television set, you will find a refrigerator. So, I mean, as the time changes, the priorities also changes, the definition of luxury and the necessity also changes. But when we say that what is luxury, what is necessity, again I would say it depends on your level of income, right? So each one of us must save a proper money, and we should not use the loan for unproductive purposes. Only for productive means buying, as I was talking in some other points, taking a loan for purchase of house is not a bad thing. But if you are taking a loan for you're managing a party at your home, it's not a good thing, right? So for which of your expenditure you have to take a loan, it is also part of the financial planning. It helps in the tax reduction. As I said, when I'm talking about the financial planning, it also involves the investments. Your saving must be invested in a manner so that you can minimize your tax payment. Right? When I use the word minimize, friends, there is a difference between tax concealment and tax planning. Tax concealment means that your income is supposed to be taxed, but you are concealing this fact with the tax authorities. Tax planning means by smart tax planning, you are trying to reduce your tax liability. Say for example, I want to make savings in a comparatively less riskier investments. So there are two options before me. One is I can deposit my savings in a bank fixed deposit, right? And the other is I can deposit my money in the public provident fund. Both gives me approximately 7% rate of return, right? So, but the interest which is being generated on a bank FD, that is taxable in my hand. But the interest that is being generated through PPF, public provident fund, is tax exempted. Not only my investment, but even the income, the interest income which I generate, that is tax exempted, is smart planning, right? So you must plan your manner, your investment, so that you can reduce your tax liability. So it helps in the taxes one has to pay on his or her income. By proper planning, one can reduce the tax burden. Assessing a person's risk tolerance and develop an asset allocation strategy. So when we are talking of financial planning, it is according to the risk profile of an individual. And your asset allocation strategy must be as per your risk profile. If a person who is in the above middle class, there is another category which we have added these days, is called above middle class. I mean, this is between the middle class and the rich class. This is called higher middle class or above middle class, which is category. So if a person is of a higher middle class, earning say 5 lakh rupees per month, that person has a relatively more risk capacity as compared to a person who is earning 1 lakh rupees, right? A person who is having a 5 lakh rupees, or given another example, a person in the age of 70 and a person in the age of 25, 30 years. A person who is in the income of, who is in the age bracket of 30 years, he has a long earning life, right? So he can make investments in certain riskier investment. Say for example, investment in shares. We say investment in shares is a riskier asset class, right? The return on the share investment on shares keeps on varying. It's a volatile return, right? On the other hand, investment in bank FD is relatively stable. So a person of 70 years, the risk tolerance of that person is not the same that of the person of 25 years. Risk tolerance of a person who is earning some 5 lakh rupees per month is different from the risk tolerance of a person who is earning say 1 lakh rupees per month, right? So you have to assess your own risk tolerance. If I have too many family responsibilities, my risk tolerance will be different. If you are earning, your spouse is earning, your children are also start earning. Or put it another way, I would say both of you are earning, you and your spouse, and you have no fixed liability, right? You don't have to spend your money on your child's education. So your risk tolerance capability is high, because you don't have any fixed liability except to meet out your monthly necessary expenditure, right? So assessing your own risk tolerance and develop an asset allocation strategy. Where you will invest your money, your asset allocation strategy will depends on your risk profile. So all people are not alike when it comes to taking risk in investing. Some may be aggressive while others may be conservative. There may be few others who may be balanced. That is, I mean, you are ready to take a little bit of risk, and a part of it you want to invest in the fixed income securities. So financial planning helps in finding out the risk appetite, that is the risk bearing capacity of each individual, and on the basis of risk appetite, suitable investments can be recommended. Safeguarding self and family against financial crisis in the event of death or disability. Friends, when we are talking of financial planning involves not only yourself, but whenever we talk of financial planning is a term which is more of family oriented, right? Family oriented means you, your spouse, your children, and your dependent parents or your parents, right? So this constitutes a family. So financial planning involves not only your own personal expenditure, but the expenditure and income of your whole family. So as we have talked about earlier also, financial planning takes into account not only the individual needs, but also the entire family member or all the family members. It is in the form of obtaining insurance protects the family in times of distress or death or disability. See, something happens, there is only a single earning member in the whole of the family, and something happens to that person. It may be occurrence of an accident, it may be death of the person. Then how you will able to meet out your financial goals? How are you able to meet out your financial responsibilities? If you are properly insurance covered, right? Then from the insurance money, you must have seen many advertisement on TV of the various insurance companies where they advertise what will happen if the person dies, right? So proper financial planning involves that any emergency, any exigency, anything arises in future, you are able to face it at least financially, right? In the event of death, disability, as I said, you are the only earning member of the family, or there is only one member who is the earning member in the family, right? So if there is anything happens in that case, where from you will able to achieve your financial goals. So when you are talking of financial planning, you must plan for it, that if any such event takes place, how will manage it. Tracking investment performance with respect to set goals. You have goals, I have talked it many times. So for achieving those goals, you have made certain investments. See, investment is also a very dynamic concept. When you make investments, it doesn't mean that you just invest and forget it. Time to time, you review your investments and see whether these investments are giving you the desired result, desired income, desired yield as per the plans, as per your planning. If they are not giving, you must take corrective action. Just to give you a simple example, you have invested your part of your income in equities, in shares. You buy a good company share which you feel is a good company and where the capital appreciation will take place. You waited for some time, and after that you find that this investment of yours, investment in a particular company's share, is not giving you the proper return, right? And the financial performance of the company is not as desired by you at the time of investment. Change the investment, sell that share, buy another one, good one, right? So it's a continuous process. If the desired result is not being achieved, take corrective action. Providing peace of mind. See, very important aspect in the financial planning, which I was earlier also focusing. It must give you a sound sleep, right? It must give you a proper peace of mind. It is said that a person who borrows without proper planning ends up in the debt trap. Friends, what I am seeing, especially in the young group of people, young students, young people, that when they start making income, right, they start borrowing and their EMI starts. They borrow for vacation, they borrow for buying a luxury car, they start from the very first month or very first year of their earning, they take loans from the banks, right? And these banks are after you for giving loans because they want to increase their credit growth, right? And you start taking loan. And supposing after 1 year something happens because there is a recession in the economy and you lost your job, where from you will be able to pay your EMI, and you are being involved in a debt trap, right? So if you are making a smart financial planning, always avoid debt trap. So when the person is unable to pay the debts, he loses his sleeps and thus peace of mind. So efficient financial planning would ensure that individuals enjoys peace of mind, right? So friends, I'm closing here, but I'll continue with this financial planning in my future lectures. Thank you very much for today.